Thank you, Mr. Chairman. Ladies and gentlemen, as you know very well, in the next future, many countries in the Middle East and North Africa are expected to show a fast and strong process of development and modernization. Notwithstanding the disruption to economic activity due to revolution and social unrest, GDP growth rate in MENA countries is predicted to grow at an annual rate of 4.5% over the period 2012 to 2016, following the last IMF data. At the same time, potential increases in commodity price, and in particular in food prices, could pose significant economic and social challenges. Looking at the demographic framework, the Mediterranean area is one of the most dynamic regions in the world. Population in MENA countries has been growing at an average rate of 2.1% in the 10 years period 2001 to 2010. Urbanization process is also very sustained. Following the more recent World Bank data, in the last 20 years, people from MENA countries living in urban areas shifted from 55% of total population in 1991 to 62% in 2010. These dramatic changes will imply a growing demand for long-term investment in infrastructure. In fact, most of the people living in the Mediterranean area will aim to have the same living standards which characterize the advanced world. It is economically convenient and politically binding to share the size of the actual growth phase in MENA countries by means of regional governance and strong cooperation. From a structural perspective, it is extremely important that economic growth will go hand in hand with a sustained process of job creation in order to offset the growing labor force and to ensure a socially inclusive pattern of development. In this respect, long-term investment in core infrastructures, including ports, airports, railways, highways, water and sewage system, energy networks, as well as health and education building, may play a key role. In fact, they improve business and consumers' environment by modernizing the interconnection framework and lowering the transport costs. They support the green economy and thereby induce sustainable growth, which is able to fulfill the rapidly growing needs of the urbanization process. By creating new jobs, they sustain employment and global stability, strengthening in this way the social cohesion. Although MENA countries generally have low levels of public debt, they need to attract private capital when considering the huge amount of the investment required and the limited size of their public budgets. However, we must consider that in the next decades, we will have a huge increase in the demand for fixed capital investment in advanced countries, but above all in emerging and developing countries. In fact, the catching up process in income per capita in those countries will require vast investment in infrastructure like transportation, telecommunication, energy, water supply, and urban development. Therefore, in order to finance strategic infrastructural projects in the Mediterranean area, it is very important to increase the capability to mobilize long-term capital from international markets. There will be an increasing need to mix public and private resources in terms of finance, human capital, and expertise by bringing together distinct advantages from the private and the public sector in strategic fields like infrastructure. Public-private partnership can provide effective ways to deliver infrastructure projects. In particular, they can offer extra leverage to key projects to deliver shared policy objectives, such as combating climate change, promoting alternative energy sources by increasing energy and resources efficiency, and supporting sustainable transport systems. In addition, PPPs offer capacity to leverage private funds and pool them with public resources. To this aim, long-term institutional investors, in close collaboration with financial institutions and private companies, could play a key role for the future of the economic and social development of the Mediterranean area. To foster private investment in PPP activities, some environmental condition is particularly important. Above all, political stability, certainty of legal framework, a favorable context for private investment, a good regulatory framework for PPP and project finance, a favorable taxation system, an independent and effective judicial system and regulatory authorities, and balanced risk allocation between public and private sector. At the international level, to support PP investment, there is a need to move towards two directions. To create a new international regulatory framework more favorable, or at least less penalizing for long-term savings and long-term investment in social infrastructures, environment, renewable energy, transport, innovation, and R&D. And secondly, to introduce new financial instruments for financing infrastructure. The recent European experience in developing new institutional long-term financial instruments, like international equity funds and the Project Bonds Initiative, represent an important breakthrough. More general credit-enhancing mechanisms are able to lower the risk and decrease the cost of long-term initiatives in strategic sectors such as infrastructure, energy, and technology. Within this framework, the Italian Cassa Depositi e Prestiti can play a key role. Cassa is a long-term investor, which mission is to finance the economic development of the country. Its assets are equal to about 250 billion euros, part of which are explicitly devoted directly and indirectly to finance infrastructural projects, both in Italy and abroad. According to CDP business plan, in the three-year period 2011 to 2013, 11 billion euros of new resources will be invested in the infrastructure sector. CDP recently launched several international activities like the Export Bank Initiative, which has already financed their first commitments. In particular, CDP is one of the main partners and investors in the international equity funds Margherita and Inframed, which may be a prototype of a new family of international equity long-term funds for infrastructures. At this stage, more instruments for collaboration should be also promoted, for instance, in sectors related to carbon saving and renewable energy. Inframed is a joint initiative of Caisse des Dépôts et Consignations of France, Cassa Depositi e Prestiti of Italy, the European Investment Banks, Hermes Bank of Egypt, and Caisse des Dépôts et Gestion of Morocco, which can be a laboratory for building a new model of development and fostering cooperation and peace among the three sides of the Mediterranean Sea. The fund will invest mainly in greenfield projects in the fields of sustainable urban development, transportation, and energy infrastructures by adopting a social responsible investment policy and respecting minimum requirements of environmental protection, social impact, transparency, and procurement. The fund has a target dimension of 1 billion euros, and it is now starting the investment phase in several countries like Morocco, renewable energy, Egypt, highways, energy and sewer system, Turkey, transport, energy and hospital, and in Jordan, renewable energy. It is also worth mentioning MedGrid, a new project for creating 2 gigawatts electric interconnection between Italy and Tunisia. The project could involve the participation of Inframed and Terna, which major shareholder is Cassa Depositi e Prestiti, among other international partners. The financial closing should be completed in 2013 with a target of 1.5 billion euros. Other potential alternatives do also exist to raise funds for infrastructure. Project bonds and guarantee schemes for energy or transport programs could be particularly important in cases when leverage is severely diminished. New asset classes can be created to attract investors seeking to match their liabilities with long-term fixed income assets, including European households and foreign sovereign wealth funds. For instance, the European 2020 Project Bond Initiative, recently launched to provide European support to project companies by issuing bonds to finance large-scale infrastructure projects, is a good example. A similar Mediterranean Project Bond Initiative might be considered in order to finance PPP in the Mediterranean area. A network of institutional long-term investors like EIB, ABRD, KfW, Cassa Depositi e Prestiti, could also provide debt service guarantees to cover project bonds. Their solid reputation and technical expertise in assembling PPP projects could attract investors, helping fundraising processes. To conclude, investing in infrastructure in the MENA area will contribute to foster economic development, peace, and social cohesion in one of the most dynamic regions in the world in the next decades. Thank you.